Greetings, it is time for another monetary creation update. And as always, we go to this Yardeni report because a lot of things in the world economy are in flux, and the confusion from the economics establishment is becoming more and more severe because almost none of their models, which are quite out of date, 60 to 70 years out of date, are doing what they predict. And we'll see why that is. These are the balance sheets of the four largest central banks of the world that comprise 85 to 90% of world money printing. Red is the US Federal Reserve, blue is the European Central Bank, and then the Chinese and Japanese central banks, as you can see. After the large amount of money printing, partly due to the COVID-19 crisis, there has been a campaign to deprint, which is not necessary, as we'll see later in this video, but there's a big campaign to deprint money, and deprinting is what they're doing. But now, technology, of course, is borderless, and money printing is also borderless. And I have always contended from my atom thesis that technology generates more and more productivity that is exponentially rising, and that productivity takes the form of cost savings, which is often deflation in an economic sense. And therefore this money printing is merely offsetting this exponentially rising technological deflation. So these four central banks should only be looked at in combination, and in doing so we go to this next chart. This is just the sum of the four central banks we just saw above. And as you can see, when quantitative easing began due to the financial crisis in 2008, every time they tried to stop printing money, there's a market correction and they're forced to print more and more. Every time, 4 or 5 times. Yet those PhD economists are stuck in models that are so out of date that they don't question those models, and they are content to make wrong predictions because their profession does not penalize wrong predictions. And so this deprinting is occurring, but it's still very little compared to the amount of printing that is done. It's still nowhere near the early 2020 level in their deprinting, and I contend it has to rise back to this trend line. Because if technology is exponential, then this exponential trend line that should be about here is where printing should be, and therefore this should be up here. And therefore we are more than $10 trillion behind where we should be under a natural cruising speed, and this comprises insufficient liquidity in the markets, which will eventually cause a correction or some other breakage, and I'll talk about that as well. I've also said that this growth rate has to be at a 16 to 24% a year annual band. So let's see that as the next chart. This is the annual growth rate of the chart we just saw above, and I have always said 16 to 24%. I said that even when there was far less data to go off of than we have today. And only when they print a lot do we even approach the bottom range of that bound, 16%. Now, one time we went way higher because of the response to that COVID-19 situation, February of 2021, almost 3 years ago, where this briefly reached 46.3%. Now, that is a level at which even I would say that there could be temporary inflation, but remember, this was also just offsetting this, as well as offsetting the future, and the brief blip of inflation we saw in 2022 could have partly been because of this, but it was also because of a concerted effort to increase oil prices combined with the invasion of Ukraine by Russia, which also increased oil prices. But now we see the growth rate is negative and has been negative for a while. It is here when it should be here. And that is also that $10 trillion delta we just saw in the chart above. That is how much money printing would be needed just to catch up to where we are supposed to be. So how long can the system hold out with this much of a gap? Well, let's look at that further. One small sidebar that I like to talk about. This is each of those four central banks, how much money they have printed as a percentage of the GDP that they preside over. And the reason that this is important is because in the United States, there's still too many people who think the Federal Reserve has printed so much money and that the United States is the only country in the world that's printing money, and therefore they say the Federal Reserve has printed so much money, therefore the price of worldwide commodities like gold should rise. Nothing could be further from the truth, because as you can see, the US Federal Reserve is the joint lowest of the four, along with China. Europe, it's deprinting quite a bit, but its highest point was more than twice as much as the United States, and it's still way more than what the United States did. You would think Germans would be the people most afraid of money printing, but not as much as these contemporary American conservatives and libertarians in terms of their fears of money printing causes every imaginable ill in the world. So as you can see, Europe did twice as much as the United States. But the prize goes to Japan, which did 4 times as much as the United States. The United States is at 31.2%, and Japan is at 125.4%, almost exactly 4 times as much. Now, this is a cumulative multi-year measurement, while GDP is an annual measurement, yes, but this is an apples-to-apples comparison across these 4 central banks. So the people who claim that the United States has printed so much money are unable to explain how Japan could print 4 times as much, and nobody claims Japan has high inflation. Even the people who falsely claim the United States has hyperinflation or unusually high inflation, they don't claim that Japan has high inflation. So they clearly do not know what is going on. They like to pretend the United States is the only country in the world. But now back to our previous topic over here, this cumulative money printing amount and the S&P 500 stock market index, which is a very comprehensive index. It's about 98% of the US stock market, and therefore a huge portion of even the worldwide stock market, and certainly an index that contains all those big tech companies. These 2 lines were very closely tied for a long time, although now they're decoupled. The S&P 500 should be down here, 3,600 to 3,700 relative to the amount of printing that has been unwound. Yet we see this gap opening up. And that is for the first time. Never in the last 13, 14 years did we see a gap like this. And this is why a lot of people are waiting for market corrections, and I have also done those crash watch videos, but the market is not correcting. As to why that is, there were 2 possible explanations. One is that a type of money printing that is not on the balance sheets is being done. And then there's a second explanation that I'm going to explore in videos subsequent to this one. So we'll go to the first one, which I brought up last month. This is the Fred M2 chart, and it correlates with the US balance sheet and even the world combined balance sheet quite a bit. But as we go to this 5-year chart, we see that we have the COVID-19 increase in money printing, and then the expected decline in M2 from the unwinding that the central banks are doing. But then there was this interruption like this. And what happened here? We go to this 1-year chart. You see this brief blip upwards, but now it's moderating down again. And this was because of that $300 billion bailout of Silicon Valley Bank, which was done via a balance sheet mechanism of the Federal Reserve. So even amidst their deprinting, they reprinted $300 billion more. That means that the caveats under which they will print more money are increasing, but this increase in M2 is attributable to that via some lag effect. It takes a couple of months for that bailout money to circulate. If this were continuing to rise, there might be some other reason beyond the Silicon Valley Bank bailout that could be attributed to this, and it would lead one to think that a new type of money printing is being done. But since this is moderating back down, it is matching the decline in the US Federal Reserve balance sheet, that red line that we saw before, and therefore a new type of money printing is not being done. We wanted to explore that, and I brought that up last month and the month before. Now we have enough data to conclude that no, there is not a new type of money printing being done. So what is going on? For that, I will have a video subsequent to this one that explains a new type of problem that's emerging in the economy due to too narrow printing. And the fact that the Federal Reserve money printing is only done in 2 things, mortgage-backed securities and treasuries. A problem I've cited many times, but that is a topic for another video. For this video, now we go on to part 2, which is an inflation assessment, and to see whether all of this cumulative money printing, which was $26+ trillion worth, how much actual inflation is that causing? So we go to part 2. And in this month's inflation update, we go to my familiar matrix, where I have the usual 3 measurements on a 10-year window. The reason for having 3 measurements is so that we get a multi-dimensional assessment, and no one can say that a certain index is rigged or a certain data point was cherry-picked or whatever. This is very comprehensive through 3 relatively unrelated indices. And we take long 10-year windows because that smooths out short-term noise and media-driven fear. So we take the 10-year compound annual growth rate of the US CPI, the 10-year compound annual growth rate of the Goldman Sachs Commodity Index, and the 10-year US Treasury yield. And inflation is optimal when all 3 of these numbers are exactly at 3%, and inflation is higher than optimal when all 3 are above 3%. Why 3%? Because inflation is the fuel of technologies, and 3% is the level at which technology gets enough fuel to progress and generate more technology without causing too much hardship for the lowest income tiers of society. Now, if one did not care about the lowest tiers of society, they could say that inflation of 4% is optimal and some poor people will die off. But no, I don't choose that type of approach because that is not a humanitarian approach. But inflation that is too low is also extremely bad for all types of people. Poor people, wealthy people, everyone. Deflation is extremely problematic, and it's troubling how many people are out there now who think deflation is good because they have a very primitive, very unnuanced view of what inflation really is and what it isn't, and how if something they're buying rose in price, that is the greatest injustice of all time. But if something they own rose in price, or if their salary rose, then that had nothing to do with inflation. That was just their own excellence. Too many people think that. So let's go through these measurements one by one, starting with the Goldman Sachs Commodity Index. This is the Goldman Sachs Commodity Index from the S&P website, and the 10-year compound annual growth rate is minus 0.81%. Minus 0.81%. It is in deflation. And this is one index which is the most important for at least two reasons. One is that it comprises of freely traded commodities like oil, natural gas, gold, silver, etc. So no one can say that this index is rigged. Secondly, this is an index of commodities that are priced worldwide. Gold is priced worldwide. Oil is priced worldwide. Therefore, it has a comprehensive nature to it, whereas other indices are U.S. only or specific to one country only. Even the U.S. CPI that we'll see in a minute, that is U.S. only. And the other reason that commodities are the most accurate measurement of inflation to the extent one wants to correlate inflation with hardship is that commodities have a very, very minimal labor component. Therefore, commodity prices falling is almost always consistent with standards of living rising at the worldwide level, while commodity prices rising is usually consistent with standards of living falling at the worldwide level. A few oil exporters making a lot of money at the expense of the rest of the world is still a net poverty increase for the rest of the world, a prosperity decrease. Services inflation is not included in the commodity index, and rightly so, because that is very ambiguous about whether it is good or bad. If there's service price inflation, that means you might be paying more for a service, but if you're a service provider, your salary rose. So service price inflation is simultaneous with wage increases, and therefore the two are not easily separable in terms of what is good, what is bad. People compartmentalize this in their minds by saying, well, if service prices rose, that's terrible, but if my salary increased, that's not inflation. I deserved it, and that is an unmitigated good. If the person who pays me has to pay more, then no, I'm going to change the subject to something else. That's what they do. So now we go to the next measurement, the 10-year U.S. Treasury yield. 10-year U.S. Treasury yield, 4.71%, so that is well above 3%. This is high because the Federal Reserve and other central banks of the world are tightening. They're deprinting money. They should not be deprinting money for reasons I explain all over this channel. But because this is high, this is very, very negative for real estate prices. But it is 4.71%. That is higher than it's been for most of the last decade, but it's low relative to the 1970s, 1980s, even 1990s. So now we proceed to the third measurement, the US CPI. This is the BLS.gov website, and the US CPI is an index that we can see here. And the 10-year compound annual growth rate is the difference between what the index measurement is now versus what it was 10 years ago, and then dividing that into factors of 10, the 10th root of this differential. And I'll have a table in a minute that displays that in detail. But you can take any time window you want to see what the general trend has been. 1 month, 2 month, 3 month, 6 month, and 12 month. So as you can see, there was a spike of inflation that ended more than a year ago, and since that time, things are back down to the cruise control speed of 2 to 3%. So now we'll look at this CPI data in a table that provides additional clarity. This table is merely that BLS.gov CPI index formulated in a way that gives you an annualized growth rate for whatever time window you're looking for, which means obviously 1 month inflation has to be to the 12th power, 2 months to the 6th power, 3 months to the 4th power, 6 months square, and so forth. The same goes for windows longer than 1 year. 2 years has to be a square root, 3 years have to be a cube root, and so forth. The 1 year inflation, which some people think is the only measurement that matters, except that they don't say that when the number is not high enough for them to whine, is 3.7%. But the 10-year inflation window is only 2.8%, and this is the one that we are looking at for the purposes of my table, because we want to smooth out all this noise and recognize not just the distortion from COVID-19 central bank printing, but what the mega trends are. It's very analogous to how a person has to rise to a certain elevation before they can see the curvature of the earth. And I've also added this row for greater perspective since January 1st, 2001. So the entirety of the 21st century, the average annual inflation rate is 2.5%. So now we go back to my matrix. So we saw all three measurements: the 10-year compound annual growth rate of the US CPI, the 10-year compound annual growth rate of the Goldman Sachs Commodity Index, and the 10-year US Treasury yield. And the results were 2.8% for the US CPI. It is getting close to 3%, but it has not crossed 3% yet. And remember, 3% would be optimal. Only above 3% would start to become high. The Goldman Sachs Commodity Index, this is in deflation. This is very far from 3% growth. The technonomic medium of the world increases commodity supplies or increases the adaptability of alternatives to commodities faster than commodity demand can rise, and that's why this is in deflation. That's why oil prices are much lower than they were even 12 years ago. Gold prices are about the same as they were 10 years ago. Only the US Treasury yield is above 3%. It's at 4.71%. So this one is high, but these other two are not high. And like I said, I need all three of these to be above 3% before I say inflation is structurally high. Now we're going to look at some other data for a bit of fun. This is from CNBC, and it's speaking about just the recent month, September 2023 inflation. Now that is way too short of a window, but when inflation was high, the people who were extremely committed to pretending that inflation is super high were out in force, and now those people are nowhere to be found. They left all sorts of ignorant comments over here, but they will never show up here now, because look at what is happening with certain types of food, energy, and other necessities. Which type of food fell the most? Eggs. In just 1 month, down 14.5%. There was a tremendous amount of hysteria when eggs briefly spiked in price for 1 month. 1 month, which was February of 2023. And people acted like the world was about to end, and they're still complaining about it. 9 months later, they're still complaining about how they were inconvenienced in February of 2023 because egg prices became high. I mean, how long are they going to complain about that? What next? They're going to complain that when they were 11, another 11-year-old child called them a bad word, and that still is bothering them to this day? Because this is almost that bad. And then you see other things that fell. Number 3 is butter. Now, I did a video analyzing the illogic of the egg situation up here in the tag in this upper right-hand corner. But then when you look at number 3 on this list, butter, that was another thing that was causing hysteria. People were losing their minds because the price of butter supposedly rose. And the question was, how much of your income is really spent on butter? Does the price of butter really matter that much to you? So I did an entire analysis of the butter situation and the pricing and the supply-demand dynamics of that in this video up here in the upper right-hand corner in that tag you see. So you can go down the list. Further down here, energy. 2 major types of energy have fallen in price. Utility natural gas service has fallen right before winter. That's quite timely. That's good. Fuel oil has fallen, minus 5.1%. The fact that they can fall before winter means the structural deflation is actually higher than it seems, which means that by April or May they will be very low in price. And then health insurance has fallen by 37.3%. Now the U.S. health insurance market is very fragmented, and a situation that applies to one person may not apply to their neighbor at all, but the fact that this can go down is very, very substantial. This went down by a huge percentage. Now, so many people have lost their minds on the subject of inflation that they will reject any good news out of hand. They'll use anecdotes to say, I know someone who knew someone who knew someone who lost a lot of money because of health insurance costs 10 years ago, as if that affects this data in this particular month, which was much more recent. And all these other things have gone down in price. So a lot of things are falling in price because inflation is structurally trending down, as we saw. And it's certainly not high if you actually care to look at the data and are interested in accuracy rather than nihilism and a victim mentality. Because on this channel, we look at data and see what the conclusions are from there, rather than try to get into a fad-based narrative, especially when we live in an age where pessimism and victim mentality is considered a virtue. And that's why you can see this video up here in the upper right-hand corner, which is a 3-part series of how conservatives and libertarians have utterly lost their mind on the subject of inflation. Inflation has become to conservatives and libertarians what climate change has become to the left. If you like this type of content, I encourage you to subscribe to this channel, and thank you very much for watching. Technological singularity, Elon Musk, Tesla, inflation, Ray Kurzweil, Federal Reserve, inflation, hyperinflation, artificial intelligence, AI, Elon Musk, Tesla, Ray Kurzweil, technological singularity, universal basic income, technological disruption.